Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Are you afraid to look? Are you afraid to look and open your statement? Well, not if you're a Revere client. If you're a Pie Charts or us, it is ugly out there, folks. Look, I've always said it's always a good time to come to Revere, but the best time to come to Revere is before the next bear market. Well, folks, we're over halfway there. We're almost there. What are you doing? Have you made any adjustments? Or are you staying the course? The markets always come back. Or my personal favorite, it's not a loss until you sell it. Folks, if your advisor tells you it's not a loss till you sell it, fire him on the spot. That is a dumb statement. It doesn't make any sense. If he tells you that, have him call me. It's not right. Anyway, I had a lot of calls yesterday. I had a whole lot of calls from people wanting to figure out what to do and wanted to test out Revere. They wanted to do a little test portfolio for $50,000. That's our minimum. And I said, no, it's 100 now, because we're doing so well and we're growing, and we're not going to let you just try to do a little and then try to copy us and do what you're doing with your big money. But the problem is just a little starter account doesn't help you. Listen to me. I just want to be honest with you. The little account is not going to protect your total nest egg. It'll feel like a Band-Aid. It'll make you feel like you took action, but it's still not going to protect your nest egg. So you still need a sell discipline for your big mothership, for like gold bugs. They want to buy physical gold to protect their portfolio. Say they got $1 million, they buy a couple $1,000s in gold. That's not a hedge. You need about 10% or 15 to actually do something, to actually do what it does. Same thing here. So I had lots of people call me yesterday because they were totally scared. Look, the market was down about 5% yesterday. We were down around 1%. Today, we're completely flat. In fact, part of the day, we're up in the green. We might be right now, but we're roughly flattish. Donald, we'll get in that in a minute. Market was down 3.5, 4 last time I looked. When the market goes, when it sells off fast. Okay? Now, what is the plan for your money? That's an important question. Your physical health, your medical health is number one. Number two is your financial health. So what is your plan, right? Are you scared right now, or are you relaxed? See, at Revere, we're perfectly relaxed. In fact, we've already gotten defensive. We're actually looking on how to re-enter and get back in when it bounces on the upside. We're actually looking for our next entry point, not how to get out. We're already out. That's the difference. Okay? So if you're still scrambling and you're trying to make a plan, see, we already had a sell discipline. We already had a plan. Like, we made a plan before the fireworks, before the bullets were whizzing overhead, before you're in the foxhole. You want to make the plan in advance, like you're sipping a margarita at the beach, so that when it comes time, you can execute. In any event, so we're going to talk honestly today about the lie charts at Pie Charts or Us from stripmalladvisors.com and tell you why they don't work. Look, everybody knows Ray J and Ed Jones has Pie Charts or Us, but I actually got a call from a guy that had I think Merrill Lynch, Morgan Stanley, one of the hallowed grounds of the mahogany walls, and they had the pyramid. It's kind of like the Maslow's hierarchy. You know, you got the lowest base, your core, your needs, what you need. And then you got some for the middle, kind of your wants. And then finally, the top of the pyramid, your desires, that can be your aggressive 20%. Folks, that's still the same pie chart asset allocation. They just put better lipstick marketing on the pig. Okay? Here's an idea. Why don't you measure risk and actually take more risk and get more involved and be very aggressive when the market is clear and then when it's strong, when there's a primary uptrend, and when it gets ugly like now, you get defensive and go flat and get out of the way and not go down. So, because see, money is not made evenly. That's why those illustrations at 5% or 8% annualized, it never happens like that. There's a thing called sequence of returns. The order of returns is important. And if you take big drawdowns, it crushes your return. Okay? Now, Now, maybe I'm just overthinking it. Maybe I'm just overthinking it, and maybe we just need to be patient and stay the course, and the market always does come back. Or you could have this. So I am going to go to the mailbag. These are just 3 or 4. I got about 15 phone calls yesterday thanking me, and I got a bunch of these, but these are a few ones, and a couple of them are from new clients, right? So this is 4. These are all from yesterday. Dan, just a few your words to let you know what a different feeling I have knowing I wasn't getting decimated in the markets today as a result of the protection part of Revere's model. It's much more comforting knowing that Revere is proactively managing my life savings as opposed to sitting with a pie chart model, hoping and praying. This is something I will not miss. At 71 years old, the time in the market is not on my side. Best regards, DK. Me, thank you for the kind words. That is why we do what we do and make your money, clients' money, look like our money, our own family and friends. Same price, same timestamp, same actually purchase and sell. Anyway, cheers. Enjoy the podcast. Sleep well and peace be with you. Anyway, 4-3. This is from MB. I suppose that pie charts are the way that the vast majority of the investing world works. How sad. Don, very sad. MB, the tsunami has arrived and you keep us afloat safely. Thank you. Don Swan, that means sleep well at night. It is one of Revere's, that's my comment, one of Revere's many mantras. MB answered back. As I watched the stock futures plunge yesterday evening, I went to bed dreaming of sweet sugar plums without a care in the world. I knew that you are the man with the plan, talking about Don, and I knew you would follow the plan. Folks, having rules is not enough. See, most traders, most investors, active investors, they've got rules. They don't follow them. That's what makes Don good. That's what separates Don from a lot of other traders. Okay. Anyway,
hey, Dan, MB actually, he invented Swan, SWAN.
Congratulations.
That was him,
yeah. Hats off to him. He is actually he's a loyal client. He follows us and he follows us loyally. 4-3 SB. This is a new client. Looks like I came over at the correct time looking at the markets today. If I was still at Fidelity, it would have been a massacre. Yeah, the Fidelity pie chart, their kind of version of the pie chart. Me, absolutely would have. Diversified portfolios lost approximately 3 to 4%, aggressive 5 to 7%, and some canceling investors really got hit. Price is truth, no exception. Welcome home. Okay, so, and I got another 15 of those yesterday. Okay, so I have a question for you, the listener. You need to look at honestly and audit your advisor. And if it's you, you need to honest yourself. Be honest with yourself. Look, I'll give you all the data you want. I'll give you everything you want. We're an open book. We put out what we do every night that the market's open. We have far less drawdowns in the S&P. But you come over here and you want to look and you want to test. That's fine. I want you to. But I'm going to ask questions about how you're doing too, because you got to be honest with yourself. When you go to the doctor, you got to tell them your symptoms. So I'm asking you, I want to help you, but let me help you, because a lot of people, they can't get out of their own way. They've got too much fear, or they're worried about control, like what we'll do. Folks, we don't custody any assets. They're held at Schwab. Schwab's a custodian. They're just a commodity to us, just like Fidelity or IB. They're a licensed custodian to manage the assets, so you can never get mad off by us. We only have limited discretion. We can only charge management fees and then execute the trades. And you can watch the trades every day in real time. You can watch them at night. So you can know within a day or 2 or 3, if we're being honest, and we're putting in the newsletter, the video newsletter at night, what we're doing every day. So you'll know within 3 or 4 days, becoming a client, if what we're doing and what we say we're doing is actually what we're doing. And if we're not, you could just de-link from Schwab. See, Schwab holds the money, not us. We just manage it for you. It's a much better way. Our clients are not freaking out right now. So anyway, if your advisor is telling you to stay the course, the market always comes back, That's okay if you're an oak tree, because you have enough time for the market to come back. With humans, we don't have enough time. It makes it random. That's what I'm talking about, sequence of returns. You need to look those up. That old pie chart, that saving $1,000 a month, making 8%, you have $1 million at 65. Now we've got enough data points showing that's not true anymore. You may have $1 million or you may have $500,000. The variance is literally half. So my personal favorite, my personal stupid statement, it's not a loss until you sell it. Folks, it's a loss the day that stock went down. Okay? You know the only difference between a realized loss and an unrealized loss, besides how you treat it on your tax form? It's when your wife finds out about it. Okay? Look, the honest truth is, the moment that stock went down, you lost the money. It's the liquidating value of your account on a daily basis. Be honest with yourself. If you're struggling, call us. We'll help you. I'm telling you, we're so open, we're so transparent. And my trade, I'm buying a stock for you, I'm buying it from my 92-year-old mother, Don's wife, and me at the exact same time, at the exact same timestamp. In fact, the tracking performance of the portfolios, of all the portfolios in protection, are within 1/10 of each other, if fully assimilated, less the management fee differential, because bigger accounts have less management fee because you cover the cost, right? I don't charge myself a management fee, obviously, so I've got about a 1% higher. I'm a little bit higher, right? But besides the management fee differential, everybody gets the same price, same timestamp. Why? Because we manage risk to the market. Is the market dangerous? We're out. If the market's not dangerous, we're in. We don't manage to your risk tolerance. Why? Because it changes. When the market's going up, everybody wants in. When the market's going down, everybody turns into a wimp. They have different pain thresholds, but they'll hit their pain threshold and they'll get out at the wrong time. That's why this is a much easier way to invest, in my opinion. You don't have to go through these wild swings, these wild rides. So philosophically, we'll go down the first 7, 8, 9% with the markets. We pull back single digit. You got to let it breathe. Once you start getting toward correction territory, we start going out in layers based on technical levels. I don't go over that, and we'll go off in layers. Then at that 10%, that magical correction point, but I'm rounding, roughly 2 out of 3 are going to hold and come back, and we'll get a little whipsaw there. We'll be behind when it snaps because we got heavy in cash. So when it starts snapping back, we'll underperform. But that's okay, underperforming a couple times, because one out of 3 or 1 out of 4, it keeps going and it goes down like now. And now you're grateful you have Revere. And we'll make it up on the other side. Actually, we're actually making it up right now. We're outperforming last year, the S&P, and now we're outperforming this year. So anyway, if you want a better way to manage, right? And if you want your money to look exactly like my money, come join me and Don in the Revere family. And then once you come on board, we'll show you what we're doing that night if you really care that much. All right. So with that, one last question. This is it. This is a last week I read that thing about a professional trader. This is another thing. This guy's a great follow. There's a belief that once you discover the right secret, you'll barely lose. You'll never blow up an account. You'll never sit through a rough patch. Yet no matter how many strategies, you'll still find yourself in the red, because the promise of a perfect method is a lie. The real reason you fail is that you run from discipline and consistency. You hear people brag about the ultimate system. Folks, if there's really an ultimate system, why are they teaching you little going around doing these dog and pony shows, teaching you to buy their little software? Why aren't they a billionaire? Good question. Anyway, they blame it on the market, the algorithm, or their broker. They blame it on anything except themselves. They can't accept that trading success comes from a committed plan and discipline, even when the short-term results hurt. If you think real pros never face drawdown, they do. They just handle it differently. Instead of leaping to a new setup or ramping up their lot size in panic, trying to make up for it, they stay calm, reassessed, and keep executing their rules. Losing streaks are inevitable no matter how good you are. The real problem is your own weakness, but you ignore them. Okay, you need to, you don't, so it says, you need to keep hard stops. You need to track yourself. You need to go over all of your trades. Okay, action steps: identify the one habit that's killing you. You do this every month. All right, set hard limits. Document every loss. Go over it. Look at see what you did. Look at your notes at the time you bought it, folks. If you're not journaling, you're not a real professional. You need to get someone else to manage your money. You do. All right. Anyway, he goes, the best traders aren't searching for hidden knowledge. They're applying what they already know every single day without cheating themselves when it gets tough. The real secret is unwavering consistency. You can chase new ideas forever, but until you confront the fact that your impatience or your thrill seeking is your true enemy. Let go of the fantasy that the perfect knowledge eliminates losses. Folks, investing is tough. You've watched these videos if you've been a stock nerd and followed Revere. You've seen Don's consistency and the whole team. Is your advisor, or you, if you're doing it, do you have that kind of consistency? Are you getting up 2 and 3 hours before the market opens and scanning the entire market and then having a conference call with 6 professionals all going over it? Or are you trading in isolation? That's much tougher. Anyway, I've said enough. I've set the table. We've been warning you for months about a bear market. How would you handle it and be ready? You need to have a plan. We had one. Now I'm going to let Don share what we've kind of done and some of the action. So Don, with that, don't let me down.
How could I ever let you down, Dan? Although you did say
you did these last 2 days, man. You did awesome. I got to tell you, my hat's off to you.
You said it's really a loss when your wife finds out about it. Now, we've got some women out there that manage the finances for the household, Dan, so don't sell them short.
Yeah, but they hide it from the husband. The husbands are too stupid to figure it out. The wives will figure it out.
All right, now that you clarified that. Yeah, I mean, we're just, in last night's video was really the culmination of everything that we've been planning here at Revere, both for Grotection and Turbotection. I made the point on last night's video that Turbotection was actually positive yesterday, and that's how Ted and Connor are more aggressive in the portfolio, and it did exactly what it's supposed to do. They actually were on a day when the market was down 4.8%. They had a slightly positive return. Today, the market's down 4% again, and Grotection has a slightly positive return. And it's just a matter of implementing our plan. And I can draw some lines, the same lines that we draw every night in here. There was a consolidation. We broke out of it a week and a half ago. A week ago, we failed that breakout. We say it all the time, from failed moves come fast moves in the opposite direction. We undercut. This is a gold line stand. And then we rallied for 3 days, 3 days of gaps down and closed near the highs. And this was, seen several reports of Wall Street was positioned for more upside when Trump actually revealed the tariffs. And initially we popped after hours, and then he came out with the reciprocal chart, and the market just tanked, gap down on Thursday, closed at the lows. Overnight, China says they're going to reciprocate with the increased tariffs, another gap down. We're off the lows right now. This, if we're lucky, is at least a short-term shakeout, the lows of today, and now we'll monitor against there. I want to talk about, because I had a couple of people, I talked about hedges and shorts last night, but I want to talk about how we hedge Grotection. So I'm going to bring in a little bit of a chart here. We put off, as Dan said, we put on hedges in layers and we take them off in layers. There are people, even with taxable or non-taxable accounts, that said, why am I still holding the SPLG long? Well, as of the close last night, we had it completely hedged with 3 different inverse ETFs. SAH, which is the first one that we put on, that's a 1-to-1 offset for a percentage of SPLG. The next one was PSQ. This is about a 1.3-to-1 offset with SPLG because the beta is a little bit higher. And the last one is SPDN. This is a 1, because we have so many new clients coming in, they have different percentages of SPLG. With the weak market, not everybody got fully allocated to that. So the last one was customized to whatever their exposure was. Some people don't have it at all. Some people do have it. But the benefit to putting the hedge on instead of selling everything is twofold. One, for me, it's psychological. It's not easy to buy in the hole. But I've been doing a lot of studies. One of the weaknesses of our approach was how can we more quickly get engaged off of the bottom and still limit risk? Because these hard shakeouts happen, and sometimes they do put in the bottom, sometimes they don't. So the benefit of the hedge is twofold. One, you stop the bleeding. You're not going to lose any more on the underlying long, because every dollar that it goes down, the corresponding shorts are going to go up by $1. So you're completely hedged. You're not going to lose any more. We drew our line in the sand, and that line in the sand was with the break of that 200-day moving average and that 3 to 4% envelope I've been talking about. This is something new in our process too. Before, we would completely pull the plug under the 200-day moving average, but I studied a bunch of these breaks, and sometimes you just hang under that level within the first 3 to 4% for sometimes a week, sometimes 2 weeks. In this case, 3 weeks. Sometimes you reclaim the 200-day moving average, which we actually did last week, but it was a false break above it, and then we continued to the downside. But the break of that envelope got us to be fully hedged yesterday with the last 20% of the allocation to the S&P 500. We've been out of individual names on Grotection. So the benefit then of the hedge is that if you continue going down, we can monitor our total long against our total short and take profits. We've done profits to the downside twice today on PSQ. And what that does is rebalance dollar for dollar, lock in the gains. If you reverse and go down, you're still in a dollar for dollar situation with the underlying long. If you go higher, we can lock in more gains with the PSQ hedge. So in other words, we're in a no lose, only gain situation with the full hedge, as opposed to being completely in cash and wondering when we should be getting back in. So that's the benefit.
Yeah, hang on one second. I want to put my Don Terpreter on and explain that for some people, so that didn't elude them, because what he's doing is so damn sophisticated that the pie charts advisor that tells you stay the course won't even understand that. Okay, what Don's saying is, so say you've got a hedge, you got a stock, you think it's about to get hammered and go down, so you short the index, you short that, and in a perfect hedge, it would be net neutral, right? It would be net neutral. Well, what most rookie people do when they do put on a hedge, if that stock does in fact go down like you think it would, then your hedge is going up. You're getting some profit. But now the hedge is actually more than the stock itself. You have a disproportionate. You're actually slightly net long on that position. Don is selling that net long. He's taking that net short. He's taking that little percentage of profit that he doesn't need anymore if he really wants a perfect hedge, and he's taking that off and he's booking it. He's booking that little profit. What most people do is they'll just let it bounce around, and then when the stock reverses and comes back all the way to neutral, you can take the hedge off, but then you're net neutral. This way, Don is booking little portions of the hedge profits while maintaining the hedge, and then when he finally unwinds it, he actually has scraped a few more little bits of return out of that hedge. It doesn't just be in other words, if you truly just hedge it 100% and then unwind it all at once, you're net neutral the whole time. This way, he's squeezing some of the profit out of it while it's happening, while maintaining the hedge, if it moved in the direction he thought. All right, Don, go ahead. I just wanted to make sure the listeners understood that, because that's one way to really hedge while still squeezing just a little bit of the profit out of the hedge instead of just letting it go away.
Exactly. That's exactly right. And then if you get to the situation to where, and this is the other psychological aspect of it, if we get we're monitoring for a follow through day now in the indexes, which is ideally 4 to 7 days off of the low. You get a big pop in the indexes with volume. That's the first part of it. The second part of it is you want potential leading stocks to have formed bases and are breaking out. That's the missing equation normally of the first pop off of the bottom. But we can take advantage of that by being in the indexes. We can take the index gains, not necessarily
Right.
gains for individual positions. So this is the latest wrinkle to the process to get engaged off of the bottom in a more timely manner. And it's just the last 20% of the SPLG. Normally, we have a 50% allocation to the indexes with either SPLG or leveraged ETFs. The core is 30% SPLG under the 150-day moving average. That's the Weinstein line. We drop it from 30 to 20 under the 200-day moving average with a 3 to 4% envelope. We keep it at 20 under that envelope. We hedge. We put the full hedge on and manage it this way.
All right. So my question is, folks, is that the reason? Yeah. Is that what your advisor sounds like? Is your advisor like really trying to collect all the gains on an actual hedge, not actually trying to speculate, like buy a stock and let it go up? I mean, that's how sophisticated we are here, and that's how we protect our own money. And if you want your money to look like our money, it's a lot easier ride, I'll tell you. What has the team got done?
It's actually not that sophisticated. It's just a common sense. It's common sense to me. But
Todd, don't sell yourself short. You have put so much sweat equity in this and put tens of thousands of hours in this. So don't.
Dan, I tell this story. This has been my life's work since 2000. My father-in-law was dying of cancer, and Morgan Stanley ran his portfolio into the ground. He lost half of his nest egg while he was dying of cancer, trusted it to them. Epic fail. And I also lost money at 2000 because I had no sell discipline. When that bear market was over,
but less than the pros.
But I went on a quest for how to keep gains and came up with William O'Neill's system. And over the years, I've been at Revere since 2016, modified it to include the ETF portion to smooth the equity curve.
Right.
And when people hear about it and hear the reasons why we do it, not just the pie chart clowns and the buy and hold people saying, you have to be right twice. You have to be right on the sell and you have to be right on the buy. And that's how they say it in a wimpy voice like that all the time, Dan. We have a plan for that. We have a plan for getting out.
First of all, you got a lot of room for error when the market goes down 35%, you go down 10. So now you got like a 25% spread you got to work with. So you got a little bit of room.
And you know what? I'm actually wrong about that. I say it in a wimpy voice, but there are people that will die on that hill that you cannot time the market. And they say it emphatically, and I spar with them on Twitter all the time. They will sit there like Nero fiddling while their clients' portfolios burn. And it like I said, it's personal for me because of what happened to my father-in-law, and I won't let it happen to my portfolio or any of our clients. It just won't happen.
Yep. All right.
All right. Let's go to the guys. We're going to start with Todd. And Todd sent me a nice chart. I'm going to bring that up, and he's going to talk about bull and bear markets. Take it away, Todd.
All right. Well, it's funny. The firm I came from before I found Revere used to say all the time to clients, it's not the timing of the market that's important, it's time in the market. So I heard that speech many times. So today, what I want to talk about is what a typical bull and bear market look like and how bull and bear markets have represented since 1960, which is considered modern times. This is a chart from Bloomberg that goes through the end of the first quarter of 2025. And the blue boxes show all the bull markets, and the red boxes are the bear markets. And we just, even though we're not in a bear market at this time, we've as of today, we've gone down 16% in the S&P 500. And incidentally, this chart represents the S&P 500. The NASDAQ composite today hit bear market territory. But the bear markets are measured by the S&P 500. And here are some facts about bull and bear markets. First of all, 78% of the time we're in a bull market. So the vast majority of the time we are in a positive market situation. In this particular case, you can see in the left-hand box here, the average duration of a bull market is 63 months. That's about 5.25 years. And the average duration of a bear market is 14 months, so a little bit over a year. So the takeaway here is the bear markets are usually fast and furious. And throughout history, the longest bear market was about 37 months long, which was in the 40s. And the shortest bear market was 33 days long, and that was during COVID. So, in general, they're typically short, but the COVID bear market was an anomaly.
Yeah.
Yeah, and finally, if we did get another bear market in this particular time period, it would be a rare occurrence because it's been very rare to get 3 bear markets in a decade period. And already since 2020, we've had the COVID bear market. We had the 2022 inflation bear market. And if we get a bear market here, it would be a very rare occurrence. But the 2 particular bear markets we've had in this decade have been relatively short and shorter than average. Finally, I'd just like to conclude that the average bear market since the 1960 has only declined 36%, where the average bull has increased 182%. But that's a little misleading because I lived through some of the most vicious bear markets of all time during the financial crisis. And, during that particular period of time, we had some doozies. The internet bubble was almost a 50% drop, and the financial crisis was a 57% drop. So despite these stats, we've had some very bad bear markets in this period. So in summary, this is really what a typical situation has looked like since 1960. And in general, bear markets are relatively short in duration.
Folks, I want to jump in and explain what he just said, because that's extremely important. He said that 78% of the time we're in a bull market and only 22 or so percent of the time we're in a bear market, right? Well, guess what? Guess what, folks? You've been lied to on the lie charts. That's the whole point. So modern portfolio theory, MPT and the efficient frontier and all that stuff is based on returns being under the normal standard distribution, AKA the bell curve. The bell curve is kind of like the middle. The mean is the average going right down the middle. That means 50% of the returns would be on the roughly 49 or 50 or 51, 52 would be on the right side positive, and then roughly half would be negative, losing years or months, depending on your data, right? But guess what? It's not. It's skewed to the right. It's like a wave breaking toward the beach to the right. It's called leptokurtosis, or it's skewed to the right. But that's not, so that means that more returns are positive than negative the last 100 years. But it's an escalator up and an elevator down. The down years have a much bigger magnitude. That's the hard part that they lie to you about. Here's the other thing. It's like a giant stepped on that bell curve. So you have fatter tails than what they're measuring for with standard deviation or variance. Said in plain English, they're measuring for the 100-year flood, but it's coming every 7 or 8 years. Why do I say that? 1929, 37, 45, 53, 60, the crash of 68, 73, 80, the crash of 87, 94, tech wreck of 2000, 2008. And now he's just talked about these last 2. So they think that there's only going to be 2 or 3 or 4 bear markets over your investing lifetime, and they're really 25. They're undercounting. So they're taking 3 steps back and 2 or 2.5 steps. They're taking 3 steps forward and 2.5 steps back. We're taking 3 steps forward and only 1 step back. It's a smoother line on the equity curve. So the long-term returns of the S&P can be anywhere from 7.5 to 8, all the way up to 15 or 16 at the top of the bull. But once you go through a bear, they can come down to 8. At Revere, our long-term average returns are more between 12 and 14. They stay higher in the range. They don't go to that lower half of the range. That's the whole point of sequence of returns. If you've got any questions on that, please call me, because that's important. That's why all of the data now is pointing to that pie charts that set it and forget it doesn't work. That's what the new science, if you want to follow the science, that's what it's saying. Don't be that person with a pie charts or us portfolio. Learn a better way. All right, who's next, Don? Yeah, go ahead.
Hey, listen. All right, go ahead, Todd.
I just wanted to bring up one final point, too. These bear markets are only situations where the S&P actually closed down 20% on a given day. We've had periods like 2011 where the S&P went down and hit over 21% intraday, but reversed and closed down 19%. And they didn't count that as a bear market, too.
Oh, well, hell yeah, that's what and they'll manipulate. They'll try to do it by the end of the year. They'll try to bring it up just under that 20 so they don't have to cut. Yeah, there's all kinds of manipulation.
Let me explain to you. This is a nice chart by Bloomberg. This is very nice laying out the data. What they did laying out the data here is to try to tell you to not sell, because Wall Street needs you to stay in to collect their fees. But let me explain to you why there's a giant lie on this chart. The left axis is has an equal weight here every time you go up 100%. The right axis is logarithmic, which shows the S&P 500, right? When you go up 582% in 150 months, they have it looking huge, right? And then, but when you go down 49% in 31 months, look how they just have this looking so tiny. This actually takes your equity curve all the way down from 600% to 300%. It doesn't go from 600% to 550% because you drop 50%. It's not, you don't just subtract the down from the total percent up. You're literally cut in half.
Yeah, that blue bar, that blue big bar gets cut in half, right?
All the way down to here, but because they showed a logarithmic chart on the far right axis, they only have it showing like it's a little tiny drawdown here. Such bullshit. Such lies by the
Don's saying that red bar should be half as big as that blue bar. Yes, absolutely.
It's outrageous. It's outrageous, but that's what they do. And when people hear our message, it's a common sense message. You don't dress for the beach in the winter. You don't dress for the winter when you go to the beach. Why do you keep your portfolio the same regardless of the weather on the markets? A healthy market from a risky market. Every night we do a video explaining what the difference is and where we are on the spectrum.
And you should own different stuff. You should own way different stuff when it's a bear market versus a bull market. Just think about it. If the market's crashing, should you have a pie charts or us? Should you just have a whole bunch of stuff? Or should you be in cash and cover up? I mean, think about it.
All right, I'm fired up now. Let's go to Connor.
Giddy up.
Semiconductors, and Ted and Connor are going to talk about the awesome shorts that they've put on over the last couple of weeks and really benefited TurboTection clients. Take it away, Connor.
Yep. No cherry picking, is gonna walk through the trade here on short semiconductors. And if you guys been watching the podcast, I feel like a month ago in February, I did a whole segment on why I thought semiconductors were heading into stage 4 in the stage 3 top. So I'm gonna kind of walk through this trade, what I was seeing, what I was thinking, and go from there. So first of all, when you look at this daily chart, I talked about the anatomy of a perfect short, and a couple characteristics of a perfect short were, number one, prior big move. Semiconductors were the best sector in the bull market from 2022 to 2023. Really just the best sector that led the market higher. So that checked number one box. Number two, highly institutional owned, and the fundamental story just kept looking better and better. And that's what you tend to see when a sector tops is there's no bad news that you can find. Everything is just how good these stocks are, and you specifically saw that with Nvidia. And then number three, once the sector's top, the best short makes is about 5 to 8 months after an ultimate high has been placed in. And what you see in these months after the high, you see multiple failed rally attempts above the 50-day. We'd go back and forth, right? It could almost look like a base, but it had those huge, large down days on heavy volume, failed at the 50-day 3, 4, 5 times. And then the final nail in the coffin for me was when that 50-day crossed below the 200-day moving average. So this really had every criteria for it. And then along just with the whole group, I talked about the group, but, I think I said on the podcast, it's, find me a good looking semiconductor chart. They didn't exist, and it's just going to be impossible for the sector to sustain a rally higher when every stock in the sector was virtually in stage 3 or into stage 4. And the stocks always lead the indexes, as we know. So into the execution, February 27th, that was when in TurboTaction we shorted semiconductors and we used SOXX. This is the 3 times short SOXX. And so what happened? NVIDIA reported earnings on February 26th. It gapped up in the after hours. A lot of people got excited. It was a good earnings report, but it was slowing growth as it's harder to sustain the trajectory that NVIDIA was on, as it was, a much less smaller market cap company. So it gapped up in after hours, and the semiconductors were gapping up into all those moving averages. And right off the open, we took this, and NVIDIA ended up finishing the day down around 8-9%, and semiconductors had a huge fade and huge outside reversal on big volume. So, and that's kind of what we like to call a news failure. All the semiconductor bulls in the market, the consensus to me was that, we just need NVIDIA to report earnings. They always gap up on earnings. That will bring the sector back to life. And that's kind of what people initially thought as it gapped up after the print. But right when the regular session started, it got sold off aggressively, and that's when we took SOXX. And so you see that strong move down, and it trickled down lower. And then around March 9th, we trimmed this for the first time. This was around $26. We had a $20 cost on SOXX, so this was around a 30% gain. And one thing I want to preface is with shorts, it's very hard to hold a 3 times levered ETF, especially short, as because the rallies can be super severe. So there's 2 things to make it a lot easier. Number one is you got to sell into strength. When you get, 3, 4, 5 R trades in these, you want to lock some gains in. And number 2 is position sizing. You have to position size to an amount where, expect this could rally back up 10% any day. It's a triple ETF. So your expectations, you have to know what you can handle. And so that's why we trimmed some as it was a little bit extended down, and my expectation was this was probably going to rally back up, as shorts just don't tend to go straight down. So trim that there, and then it started to rally back up. And in hindsight, this would have been a good add. We didn't add to it as the market was still very choppy, and the direction to the downside in the general market just wasn't super clean. So we just kept holding it as a directional short. And then yesterday, on that huge down day, we trimmed it again. This was at $32. This was roughly a 70% gain on the trims. And then fast forward to today, at the highest today, the position was up almost 120, almost 130%. I think at the highs, it was around 127%. And so you can see there's a lot of fear coming into the market. It's a very small position now, but it's definitely helped, especially with the markets going down. And I think this just shows that, one, three ways to play when the market's going, or a couple ways to play when the market's going down. You obviously have cash, you can be in more defensive sectors, and then you can also look to actively short some of the weakest sectors, and semiconductors certainly fit that bill. And we took another short that Ted will mention in his segment. So yeah, that's the semiconductor short. I think this is just one of the most perfect shorts out there, and I think it's just a good one to study. Definitely will be in my model book for future reference.
Couple of points to make about this. These guys nailed this. I was late. I came in. I did a very small, just a couple day one during this period. I'm impatient with shorts. I want to book the gains. Kudos to them for letting it ride and getting a much bigger gain out of it than I did. But we're showing a chart. This is the key thing. We're showing a chart of the semiconductor index, the underlying of the inverse ETF. Do not make decisions on the chart itself of SOXX. You always have to look at the underlying, because these are a derivative. That's a derivative of this chart, and it resets the leverage every day. So what's actually going on can be skewed if you use the chart of SOXX. You have to use the chart of the underlying, which is what we showed here. Very important concept when you're shorting via leveraged ETFs. Great stuff, Connor, and congrats to you and Ted on this one. And Ted's got another one that they wrapped up some nice gains in, and we're going to turn the controls over to Ted. Take it away.
Yep. Thank you, Don. And building off of Connor's segment on the semiconductor short, another area of the market, this is the FNGS ETF. It's pretty much the Magnificent Seven plus a few other large caps like a CrowdStrike. But I was targeting this. I saw the failed breakout and this huge slide below the 200-day moving average. But because it was such a deep drop, there wasn't a setup in there really to engage short. And really, I was just stalking it patiently. And I just wanted to say before I talk about where I entered, I did get frustrated out of the short once. And sometimes it's key, like during volatile times, to be willing to try again. And so the first time I tried the short, it would have looked like this. I thought it was enough of a bear flag, especially with a wick rejecting the 200-day on March 17th, another wick on March 19th, and then a super weak close on March 20th. So I took, even though we gapped down, I took that bear flag break, but we ended up reversing, headed higher, found resistance at the 150-day moving average, and then we started failing again. So I got put on my short list once again and ended up taking the position on March 27th. And that day still remained tight, but afterwards we broke the bear flag lows, rallied into the Trump tariff announcement, and then of course we all know what happened in the last 2 days with Trump tariffs. And it has been a really nice short so far. And today, actually, yesterday, my thought process, I'll go on a 5-minute chart. Actually, this is not a good 5-minute chart to look at. Let's use FNGD because it trades more liquid. Yesterday, it was already a big gap up, a decent 20 to 25% gain. I was really just keying on the lows of the first 5-minute candle, and whether it breaks the upside or downside, I was going to take some off. I did end up closing 50% of the position, even though I could have been a little more patient here, but my plan was if it breaks the first 5-minute lows, I was going to take 50% off because it was already a good trade. Coming in today, another huge gap down or gap up on FNGD. So FNGS, we gap down. I was going to trail, again, the 5-minute opening range lows on FNGD. And then pretty much once we reached this support level right here, and on the S&P, we touched the August lows. And then on the NASDAQ, we pretty much traded back down to the August lows as well. That's when I decided to cover aggressively into the short. Took another 50% off. So that leaves us with 25%. Actually, no, I end up closing the entire short. I first took 50% off and then I took the rest off. So we are completely out of this one. We still have, I believe, 25% of our original short in SOXX, and we're just letting that ride for now to see if we can get further weakness. So those are our two shorts in Turbo. And I guess to wrap it up, Don, I'm going to just do a quick little spiel on the optimistic side. At the top, everyone was bullish. Let's go to this chart at S&P. At the top, everyone was bullish, thinking the markets were going to go on forever. NVIDIA could never drop below the 50 or 200 day. And at now, you see the sentiment, whether they're talking to retail traders or even institutional investors, or not institutions, and on social media. People are calling for the end of the world. There's outrage left and right. People think now we're going to drop and crash forever. And CNN fear and greed is almost at zero. The NAM is dropping. We saw some other breadth indicators we look at that's signaling to us it's getting quite extended to the downside now, which is why we are covering up some shorts and starting to put our contrarian hats on again to look for potential reason to either look for potential low, short-term low that we can trade against, or at least just step aside shorts, because we are right now about 7%, 8% extended below, and this is a 10-day moving average. I can pull up an 8, but it's pretty much the same thing. Super extended to the downside from the shorter term moving averages, and that means the risk to reward now isn't on the short side at this very moment, and we are at this huge support level at 5,100 here. So that's just kind of my thoughts. And all corrections, bear markets, crashes, give birth to the next uptrend, the next momentum uptrend, where there will be big winners that go up 500%, 1,000%. They will show their cards. The groups will come together. The leading stocks will show their hand, and we will identify those on our screens as we do in our daily and weekly processes. And the team will share on morning calls, as Dan have talked about, and afternoon calls. And we'll definitely re-engage in those when they come.
Excellent. They say youth is wasted on the young, but Ted and Connor defy that every day with what they display to the team here at Revere, and we're so happy to have them on board. All right, Dan, that's it from the tech side. Take it away.
Well, I would just like to kind of close. I've been thinking about this. Todd made the comment after you showed that Morgan Stanley chart, Don, that lie chart.
Bloomberg chart, yeah, the Bloomberg chart.
Whatever, yeah. And he's made the comment that the old firm used to say, it's not timing the market, but the time in the market. Folks, if you've got a pie charts or us portfolio, you definitely need to spend a lot of time in the market, because you got to ride through those things. So you got to have the lifespan of an elephant. So the question I have is, do you have really, really good genes? Or do you have enough money where it doesn't matter? It's okay. You can take a 40% hit. I don't know. That's a question. At Revere, we're already defensive. We're out. We're happy. We're actually thinking about how to get in the next uptrend, looking for the next uptrend, because we already got defensive. All the pie chart or us crowd, they're trying to figure out what to do, and they're scrambling. And the advisors are telling their clients, just stay the course. It'll come back. It'll be all right. We're not having that conversation with clients. We don't have to have that conversation with clients. This is a better way to invest. Folks, if you want to join the Revere, or if you just want to learn more, just go to revereasset.com. Up in the right-hand corner, there's a subscribe button. We'll send you this podcast every Saturday morning. We're recording it Friday morning. And then every night, we do a video, short market video. Every night the market is open. We're the most transparent advisor, not in the country, but the world that I'm aware of. I don't know any advisor putting out everything they're doing. Then if you go to YouTube, just YouTube, and just search for Revere Asset, just Revere Asset, Zach will have this, our producer have this by 1 o'clock Central Time for the stock nerds on Friday before the market closes. So you'll get this. And you can always call us old school at 855-REAL-WEALTH. Folks, come join Revere so your money looks like our money. We'll talk to you next week on Your Money.
It's not how much you make in the markets, it's about how much of that you can keep.